And just moving on swiftly to our panel session. So today's panel is focusing on one of the, I suppose, most interesting and active topics of discussion in the past couple of years in the mining sector generally. And it's equally relevant to these markets and these geographies as anywhere else. And it's ESG linked to mining finance and investment. Before we go into some of the discussion topics, I'm just going to ask each of our panelists to do a quick introduction for 20 seconds just to say who they are and a little bit about their background, and certainly in the context of ESG, the perspective that they're things from.
My name is Katya Gorbatyuk. I work at the London Stock Exchange, leading coverage of CIS and Central Asia. ESG is very much part of our daily conversations. In addition to that, I chair a working group at the Institute of Directors focused on stakeholder governance and board effectiveness. And this year I was part of the panel of judges for the IR Society ESG Communications Best Practice Awards. And my background is in financial services.
Good afternoon, everyone. My name is David Williamson. It has down here in the schedule that I'm head of ESG operations at the European Bank. Actually, it's head of ESD operations, Environment and Sustainability Department. So I may get into trouble with certain of my colleagues there. I'm a geologist by training. Been working in the Eurasian region since 1991, always focusing on environmental and social issues. Very excited by suddenly the rest of the world beginning to catch up with the kind of green agenda, and in fact maybe passing some of us by with the way that the innovations that's coming out of the marketplace now. So looking forward to the discussion this afternoon and seeing where we can take ESG to the next stage.
Jamie Strauss, CEO and founder of Digby. I've got 35 years in mining finance at some of the leading kind of mining banks like BMO and SocGen. But more recently set up Digby to address the ESG conundrum of disclosure for the mining industry, to try and bring it all together. It was very much done in collaboration with a number of different banks, such as BMO and BlackRock and Orion Mine Finance. And hopefully we're going to try and help this industry come together and go to better places with David.
My name is Kay Hope, and I work at Bank of America. I head up the firm's effort in ESG for research on the fixed income side, but I also cover companies as a credit analyst, including companies across Russia, the CIS. I spent a wonderful year living in Kazakhstan many years ago and in parts of Africa. So it's been really interesting to kind of marry up what's happening in ESG, but also where companies in a number of my countries are doing a particularly good job.
My name is Yulia Cheripanova. I'm a geologist on background, and I have a doctorate degree in geoscience, so purely technical here. I have experience both in oil and gas and mining technical consulting. At the moment, I'm a head of ESG investment and mine capital, where ESG is deeply integrated into investment decision. So we are looking both technical side and ESG side of the assets and building portfolio built based on this.
Good afternoon. My name is Dmitry Aksakov. I head up ESG banking at VEB, Russia's development bank, and my job is to create and grow our ESG credit portfolio. And I spent all my career in financial services in Europe and in the US.
Thank you very much, everyone. I might just have to ask, when you're speaking, if you could just bring one of the microphones close to you, just so everyone can hear at the back of the room. But we'll go straight into it, I think. So we've got a number of different themes and topics that you'll have seen mentioned on the programme, and we'll try and touch on as many of those in the time that we have available. I've also got a log here of any questions that are posted, so if there are questions, do feel free to either log them in the online portal or ask them at the end of the Q&A session. Perhaps starting with David and Kay on financial products evolution and how they're actually evolving around ESG performance. It might be helpful if you just give the audience a bit of a sense as to the direction of travel that we've seen across different sectors recently around ESG performance and how that's tying into the extractive sector.
Sure. So maybe I can give a quick background on what we're seeing. When I speak with investors about ESG, I always highlight that ESG for me is really about change. And Anthony brought up a number of things in his discussion that I think were incredibly relevant. He talked about materiality, competence, and transparency. I tend to talk about transparency, innovation, and competition. And David mentioned innovation. And what we see is that these innovations around a very large ESG framework are creating a lot more competition. You know, we're expecting peak oil in the late 2020s. Why is that? Alternatives are cheaper. Everyone at our firm is talking about MIFs, metals important to future technologies. Why? Because those metals are becoming incredibly important for solar power and wind power and hydrolysis and all the processes that we're going to be needing to get to a net zero future. And then in line with that and related to ESG, we have the labeled bond and loan markets that are becoming so prevalent. To date, we've had more than $3 trillion equivalent in green, social, sustainability, and sustainability-linked bonds and loans issued. And more than 40% of those were issued this year alone. It's growing by leaps and bounds, and we expect that growth to continue. We're also expecting companies as well as countries to take an increased look at climate change and the related ESG issues as a result of COP26. One of the things we've written about at the firm is we need $150 trillion of investment by 2050 to make things like net zero happen. That's $5 trillion a year. It's 3 times what's been spent on COVID. And so ESG is a major topic for us and something that we expect to see continue to grow.
Thank you. Some mind-boggling figures there, actually. Speaking from an institution that invests less than 10 billion a year. But I mean, for those of you that don't know about the EBRD, you know, we are a publicly owned institution, and from the get-go, ESG, or whatever you want to describe it as, has been important to us. We have an environmental social policy that's been in place for decades now, and everything that we do must be viewed through that lens. So to some extent, you know, we were maybe resting on our laurels a little bit. You know, we thought we had this down pat. You know, we have a 97-page policy. We know about environment. We know about green. But actually, the institution itself, as we've morphed over the last few years, you know, we're not about profit and loss, although it's important. We're actually about transition. So we're changing the way that we're looking at transition, and green is one of the key parts around that. So, you know, we're looking at thinking that, you know, having 50% of everything we do labeled as green, it is a great result. Actually, we're now behind the curve, and we need to reevaluate that. But, you know, ESG itself, you know, we've seen an explosion in the way that ESG is being applied to financial tools. You know, we've heard some of the ideas here around green bonds, around social bonds, around sustainability-linked bonds. You know, we've seen, you know, a real geometric growth in the interest from our clients, and also from the interest that we see from the financial markets in being able to channel funds to these opportunities. And one of the things that we're struggling with, I think, a little bit, is trying to get our heads around exactly how do you define what the sustainability is for a particular type of investment, and then also how do you monitor, and importantly, how do you verify that as well? So that there is as I said, a geometric growth in the interest in this area. And you know, the financial markets themselves are developing new tools all the time, and it's, I think, incumbent on us all to make sure that we're actually delivering on the promises that are made when these financial instruments have been put together. That's going to be the next challenge, making sure that we can stay ahead of this and maximize the opportunities that are coming out for it. The need is enormous. The pool of finance, the liquidity is enormous. Getting them matched together and making sure that we're getting the best result, that's the key to success going forward. But, you know, you're only going to see more innovation.
Just moving on, Katia, what are you seeing? How are you seeing globalization of green finance? What are you seeing happening in the markets?
Well, I would like to highlight some of the areas that we as London Stock Exchange are trying to tackle. And one of them is this quest, increasing and growing quest for companies to report full compliance. And I think that's by far one of the biggest impediments to progress, because this full compliance comes at an expense of transparency. And well, here in this country, where the beneficiaries of the FRC's very flexible approach of based on the comply and explain principles based based approach, which inherently has the flexibility to focus for the company to focus on the activities and the outcomes of these activities linked to transition. But around the world, I think that one of the areas to tackle next is the fragmentation of frameworks, and that's why the welcome news recently was this news from the IFRS Foundation about issuing the harmonized sustainability reporting standards, which will include a number of its predecessors like SASB. As London Stock Exchange, we view as education and collaboration as one of our key work streams, and that's why we're chairing the UN Sustainable Stock Exchange Initiative, which is tasked with creating the model climate reporting guidance, for example, which stock exchanges around the world have started adopting and training their issuers on how to develop a green economy narrative. So that's clearly a very important initiative that will spread the effort around the world. We have our own training initiatives for our own issuers. We also have the ESG disclosure score, which allows anybody for free to benchmark their own disclosure against industry peers. And just to conclude on that topic, reporting full compliance is not what's going to get you the long-term and the impact-aligned capital these days, as the leader is getting increasingly sophisticated.
Yeah, okay, thank you. Touching, I suppose, on what's of real interest to the audience is the mining sector and how effectively the mining sector can tap into some of these financial instruments. The green bond market is one where we haven't really seen the door prized open yet. We have in terms of some of the sustainable linked financings, but can some of the speakers give us your views in terms of accessibility of these products, both those that are being used at the moment, they continue to be used more widely in the sector, and those that haven't been, will they start to be used in the sector? So maybe we'll start that one with Jamie.
Okay, I mean, I think, Kay, you might have more specific details, but from what I understand is the mining industry has, I think, raised less than $4 billion worth of green bonds to date. And given the numbers that you've just raised, you recently did, it's basically frozen out of the green bond market. What is wonderful to hear is the opening up of labeled products and everything, and it's going much wider. And I was talking to a small fund the other day who lends money either through convertibles or debt, and they've never got involved in ESG before, and now they're being asked by their clients to effectively give. And this is on the really small end of the spectrum, not just on the big end. So the problem from the conversations that I've had with some of the leading banks as well as some of the smaller companies is to open this market up, you need credible data in order to, first of all, make that investment in the first place, to make it, ensure the sustainability is there, and then in order to track it. And at the moment, that credible data is failing. There's a big Australian bank the other day who has basically stopped putting any credit or approving any extractive industry going through their credit market simply because they've got no credible data to rely on, and their reputation is therefore in danger. So we've got to get to a stage of having credible data to therefore allow the green bond market, the other label bond markets, to open up and therefore move forward. And then I see a huge opportunity for the mining sector. You know, there are lots of projects. They don't have to be the whole project of development. They could be a wind farm. They could be water treatment processes, parts of it, the whole spectrum of that investment capability then opens up, as I'm sure others on this panel probably have better knowledge even than I do. So, on that.
Do you want to answer that?
Sure. I guess I would take a slightly different tack. And I think that the sustainability linked market is really made for industries that are in hard to abate sectors. Sustainability linked bonds give companies an opportunity to plant their sustainability flag without being required to invest all of the proceeds into eligible, sustainable, or green projects. So this does not narrow the focus of your investment after issuing, but what it does do is asks an issuer to assign KPIs, key performance indicators, to their issuance. So maybe you issue a 7-year bond and you agree that within 3 years, 50% of your power will be from renewable resources. And after 3 years, you do the assessment, you have it verified by a third party, how much of your power is renewables. And if you haven't made the target, maybe your coupon goes up. If it's a loan, if you've made the target, maybe your coupon goes down. So it can go in either direction. But I really feel like the sustainability linked bond market is terrific for industries like this. It's also terrific for smaller companies who may not have $500 million to put toward eligible green or social projects, but they still want to show a commitment to sustainability. The question then becomes, what are your targets going to be, and are they robust? Are you going to set targets that are just really easy to meet so that it looks good? I know of one company that issued an SLB, they'd made the target 2 years before they issued a bond. That ends up being an issue for the issuer because they're not seen as serious. So you have to balance between setting targets that are robust and challenging and being taken seriously by the market. But what's great about it is it gives the issuer the flexibility and puts the power in their hands.
Sure. Well, many of the Russian companies, many of the Russian metals and mining companies, I noticed, are very advanced in this sector. They were among the pioneers who raised the sustainability-linked financing. And I totally agree with the previous speakers that it's all about transition. It's all about setting realistic goals. And we, as a development institution, understood that for many Russian metals and mining companies, it is probably unrealistic to issue pure green bonds because the requirements are very high. For example, right now we are working with one of our clients who is willing to raise green financing. They are in the steel business, and it's very hard to meet the strict requirements for a green bond. And as a result, given the fact that many technologies are not yet economically viable at scale, we, when developing the rules for green investing in Russia, decided to split our rule book into parts. The purely green part, which contains the very strict requirements for purely green projects, and also the adaptation or transitional part, which is for which is for industries with traditionally high carbon footprint, but which can implement projects with significantly positive economic impacts. And so far, we see a lot of interest and a lot of projects happening in the transition part of our rule book for sustainable financing.
Maybe I'll just add a quick comment because it's not only on the fixed income side that green financing is available. On the London Stock Exchange, we launched what's called the Green Economy Mark a couple of years ago, and that's for equities of companies that derive at least 50% of revenues from contributing to a green economy. And there is quite a range of classifications that one can fall into according to FTSE Russell. So that segment actually has outperformed many other sectors during the pandemic and has shown greater resiliency, and the capital raising capabilities, raising combined cumulatively more than, for example, real estate, more than retail. So so far we have only had 4 mining companies on the Green Economy Mark segment, and those are very small companies, 2 from South Africa, 1 from Brazil, and 1 from Madagascar. But hopefully more companies will find a way to align with the FTSE Russell classifications and join the Green Economy Mark, because many of them are already doing amazing things, and by virtue of the kind of metals and minerals they're mining, they are contributing to a greener economy in the long term.
Maybe just touch a bit more on this subject of transparency and whether other speakers' current transparency levels for exploration and production companies is sufficiently adequate to attract the sort of capital that we're talking about. Certainly it's sustainable linked capital. I don't know if Yulia, if you'd like to touch on that.
Thank you, Ian. It's an interesting topic because I would recall to my most recent experience 1 week I had about 30 one-to-one meetings. And I would say out of 30, it was 2 companies who highlighted their modern, I would say the most modern ESG aspect. Some companies do highlight that they are working towards social license to operate and some social initiatives. One amazing company from Australia, they just on exploration stage, they actually highlighted that they installed solar panels. They are zero net company, it's drilling stage, and they're using biofuel. It was the 1 out of 30. And majority, I would say, do not take this information as a necessary on these meetings, while one-to-one meetings are expected to be meetings with potential investors, institutional or private, doesn't matter. So this is reality which is still here. And if we speak about every other companies beside the top companies listed on the market, and this is a problem because for me, as example, I need to make sure, I need to find a way to assess the company, if it's sustainable or not, if it has this side to sustainable investment, because investors who are investing in us, there is a high demand for sustainability. I would say we are targeting a lot of interest from the companies who say we like sustainability words, but then you start to say, but we invest in mining and metals, and it's a first huge stop. Because there is not a clear link even in minds and understanding why mining can be sustainable. Where is sustainability here? So I'm here doing my homework, saying, okay, this is green metals. Green metals are necessary for sustainable development goals, and looking for each project specifically. Me personally need to do this job of analyst, job of company, to dig through websites and everything and say, okay, we're doing this. This is related to sustainable development goal number 1. This is related to sustainable goal number 7, and so on and so on. It's very hard to dig this information out. It's not available. And more important, I would say it's still not in the agenda, even for presenters of mining projects, to highlight this in company corporate presentation. That's why it's hard to sell, because we are speaking about business here, is sell and buy. It's hard to sell mining asset as a sustainable investment, and which is in reality not true, because we know mining, we know what mining companies are doing. In many cases, they do a great job. There is a lot of good initiatives, a lot of new technologies, and so on. It's not highlighted truly, widely. And I would say mining is still struggle to be seen as a source and places for sustainable investment.
Yeah, thank you for that. And thank you, Yulia. I mean, you got to feel sorry for the mining companies. I mean, if you look at the ESG, or just take the MSCI universe, there are 35 different topics, and nobody's got their head around it. And I mean, it's a challenge, but most of these junior mining companies just don't have the resources to disclose in the way that we're asking them to. A lot of them have been doing it for decades. And in fact, I think there's a very good track record in the mining industry, particularly since things like Equator Principles and IFC came out in 2003, was it? And I think the track record's good. And I don't think the industry should be ashamed of itself, but it has got behind the curve with regards to disclosure. And therefore it makes it impossible for people like Yulia and others. There's another emerging market mining fund under the Arch brand, which we're working with to try and help them as well to continue to monitor the ESG credentials coming out of these companies. So if you can provide the relevant information which addresses those 35 different topics, then you then get it then get it independently assessed. Then effectively you can bring out data which can then be credibly tracked on an ongoing basis. And if you ask the impact investors, I don't know if there are any impact investors in here. I mean, it's not surprising there's none, because they choose not to invest in mining, as Yulia just highlighted. But all of them, or I say all of them, the clear majority of them are allowed to invest. The sustainable frameworks allow mining to be invested in. So we've got this credibility problem, and we've got this knowledge problem of not having this information in a standardized way, which can be easily assessed by multiple different types of investors and other stakeholders, and then effectively to take that and take it into action from either a monitoring point of view or otherwise. And so I guess what it really boils down to is if you give them the information to disclose, they will disclose. There's clear evidence that that is the case. And David, you've probably seen that for years. This is not just a new entity.
Oh, yeah. I mean, just to jump in on that, for as long as the bank has existed, we have required our clients to report to us on environmental performance. Now, we then sit down at the beginning of a project and work out exactly what these kind of key performance indicators are, and we agree those with the client, and they report them to us. Fundamentally, what's different there to reporting publicly now? I mean, none. The process is the same. So yes, they can do it. And we work in the SME space. You know, we have one project with Rio Tinto, and that's because it's in Mongolia. Big mining companies don't need us. You know, so our typically locally owned SME mining companies can do this. The capability's there. It's just making sure that there's a good kind of common understanding and a common framework that people can understand, and also that the market understands and recognizes where the value in that is. There needs to be a kind of conversation. What does the market need? Because once that's clear, then the clients are more than capable of delivering.
And Ian, I should just follow on from David there. The opportunity, if we can come together on that, in terms of valuation, in terms of recruitment, in terms of obviously what's going on the ground, is absolutely enormous. You know, we're coming from the lowest common denominator here. The mining industry is the worst perceived industry on the planet, with the exception possibly of oil and gas. So it's not very difficult to move us off the bar when the industry is required for the transition to a sustainable future anyway. But what we've got to do as an industry is come together. That's governments, that's corporates, that's managements, that's the whole lot got to come together. And if we can have something, and I should add, the Digby frameworks are aligned to global standards. So it is not a new standard. What we've done is we've mapped with a group called Satala, all of them, of which EBRD is one of them. And we've aligned to that. Doesn't mean to say you're certified to EBRD or IFC or Equator or whatever it is like that. But at least they now know what to disclose. And they may also do EBRD or IFC as well, or SASB is on top of that. But this gives all different types of stakeholders the ability to then assess on all of those different topics.
Yeah, no, I think that's really helpful. I'd be interested to hear from Katja and Kay, just as a follow-on to that. So non-financial reporting, what does good look like, do you think?
So firstly, let's draw the distinction between a nice add-on, which is a CSR, and the case when sustainability is embedded in strategy, meaning that it drives financial, strategic, and capital allocation decisions. And so when you issue a separate sustainability report, what it signals to the investor community is that it is a side issue. It's not embedded. So what do you need to do in order for it not to be seen as a side issue? I think that you need to report firstly, what information went into the boardroom that informed strategic discussions, and how these strategic discussions then translated into key strategic decisions, and how these decisions were then turned into daily practices. So that's the basis of the kind of the integrated report. And then what will make it an effective storyteller is, you know, a couple of things here. First, it has to be of the same rigor and quality as your financial information. And what I mean by that is evidence-backed. And we've heard today some tremendous examples of this being followed on thoroughly. Secondly, I think it's critical that it's voluntary because, and why do I say that? It's because this mandatory reporting can turn into a tick box exercise, and that's an impediment of all progress. And thirdly, what we've recently looked at as part of even my work for the IR Society is that the reports are written in plain human language, because frankly speaking, some of these reports are incomprehensible for the user, and I think something needs to change. This report needs to be candid, and it needs to report on difficulties faced and how you're progressing towards solving these difficulties. And finally, it's important to remember that transparency, it's not only about accountability, it's also used by the best organizations who are adopting the best practices. They're using reporting and transparency as a drive of transformative efforts. So they're using it as actually to look back as a mirror on what they're doing and if they're doing it right.
Okay.
So I'm going to kind of sum up as well what Katya said, because I agree. But the bottom line is, I'm sorry, guys, I'm going to be the most unpopular person in the room. Disclosure's not enough. So here's a great fact. In the S&P 500 in 2020, 92% of those companies have a sustainability report. How many of those companies reported, how many of the S&P 500 talked about the sustainability report in the annual report? 16%. It's not enough. And I talked to 2 CEOs of big companies, and they said, I don't know what to do with this sustainability report. I said, but who's involved in sustainability at your organization? And one guy said to me, what, are you kidding me? I paid some Irish guy $100,000 to write it. Now I'm supposed to do something else with it? It needs to go further than that. This isn't a box ticking exercise. And not only that, the next part of bad news is we need you to have targets. We want to know what the greenhouse gas emissions look like. What does the water usage look like? What does the recycling look like? But what are you going to do about it? And not only what are you going to do about it, how are you going to do it? How do you divide this into targets? You're going to be net zero by 2050. I hope to be on a beach in 2050. I want to know what you're going to do by 2030. And how are you going to get there? And what are the steps that are needed? And as a bond analyst, how much does it cost?
Yep.
Right? All of that has to be brought into it as well. So how was that, Katya? I'll have eggs on my back when I leave.
If we look at it from a slightly different perspective, so what role, and maybe this is a good one for Katya, but what role do you see the investor playing then in supporting transformative processes that we've talked about? How do you think that's taken?
Well, especially in jurisdictions where you don't have kind of the well-developed support network, private investor plays a critical role. And primarily, if they develop very detailed engagement protocols that are highly granular and focus on deep issues identified not only based on English language disclosure, but perhaps going deeper than that into local language disclosure, and then engaging on these issues, but not expecting all companies to be perfect from day one, because that just turns company off public markets and makes them avoid this engagement, because it is hard work. But actually setting a kind of milestones and targets linked to those milestones, and recognizing that this is going to be a long-term process. And what challenging sectors, challenging industries, challenging jurisdictions need is this patient long-term capital that will be there for them supporting this transition. Otherwise, there is plenty of other money to go around, and it will turn companies into kind of the obscurity, and nobody will benefit otherwise.
Anyone want to add to that?
I think you just described the mission of the EBRD, actually. Thank you, well done.
I would just add, most impact investors are long-term money. It's longer-term money than we are used to. So if we can attract that money into the sector and give them the confidence of that credible data and standardized data, then you are going to get them in, and that will lead to better valuations. It's only a $1.5 trillion industry. It's not going to take very long to move the needle if you suddenly start bringing sustainable funds in. So
Yeah, and here actually looking only at ESG ratings and data, it's not terribly helpful because it's about the transition journey. So by definition, it's forward looking. So there are already some kind of initiatives to recognize the critical nature of those qualitative forward looking statements. Like, for example, at LSEG, we now have merged with Refinitiv. So Refinitiv ESG data, they actually track qualitative statements, future looking statements that companies make and convert them somehow into a score. So that's factored into your overall kind of like your commitment. And of course, you will be fried if you don't, perform on what you have said. But, that's a good step forward.
Go ahead.
Sorry. I would like to add something on the investment side. As a development bank, it is our job to help mobilize the private capital in order for the companies to reach, in order for the economy to reach the national goals, and in order to help the companies mobilize. And when a year and a half ago, we went to Russian investment funds and asked them, are you willing to provide financing for ecological projects, for ecological modernization of companies? Would you be interested in buying sustainability-linked financial instruments? Almost nobody was interested, but we knew that something was coming. The state was going to announce that we're going to reach net zero by some date. Well, recently in October, Russia announced that it's going to be net zero by 2060. And everyone, the whole investment community was asking, we need some goalposts. We need to understand the rules of the game. How do you define a sustainable financial instrument? And as a result, we were tasked with actually writing the rule book. The rule book that I was referring to is the Russian taxonomy that we wrote. And it's largely based on the international standards, but it is essentially the set of rules for sustainable investing within Russia. And now, as a result, all the major financial institutions and asset management firms are setting goals for their portfolios. They are announcing that, for example, 25% or 30% of our portfolio needs to be ESG by this date. So setting transparent rules, setting goalposts is very important for the investment community.
Just another quick point on that. You make a really good point there, and obviously there's the EU taxonomy also. So we now have a document which defines what is green, and that's wonderful. It enables conversations with clients. It also enables conversations with investors. But one point to bear in mind, and this is something that we've seen from our experience of green investing from 10 years ago, 5 years from now, that taxonomy is not going to be green anymore. It's going to be standard. And certainly what we consider to be green is, okay, you've got a basis of legislative compliance. Well, what's green is what's above that. So when we're having this conversation, maybe even 3 years from now, that taxonomy, that's going to be the baseline. So it's going to be a continuously evolving process. And we're going to have to revisit how we define green. And we're going to have to make sure that we're having conversations with all the stakeholders around that to make sure that we all move forward together, because it's going to be a hell of a ride.
And targets can be updated.
Yep.
Right?
Just want to add a little bit that green investment and sustainable investment area is a kind of new universe in investment field. And definitely mining companies, they have a chance to get piece out of this cake, with numbers about billions and billions in investment, ESG related fund and all of this. And this money are here. So it's a matter of change in marketing in many cases, but also to keep track on what are requirements for what is sustainability at the modern days, what is said very correctly that was green 5 years ago, it's normality right now. So it's, I just repeat, if social licenses of operate was extremely discussable 5 years ago, 4 years ago, now it's carbon emissions. Now it's water treatment, these two hot topics, and decarbonization. So literally company need to show this and change very fast in this case, because sustainability 3 years ago, 4 years ago, it's already there, it should be here. Everybody expects licenses of operate. Now it's not a surprise anymore that company is having social licenses to operate. It's like normality. Now we're expecting actions in decarbonization, water management, and deforestation areas.
I just add to some of the things on here. What is interesting, which I've seen talking to companies across the spectrum, is, and obviously we all know it's happened at Rio Tinto and BHP and everything else, but lower down the spectrum is it is now getting into the boardroom. It is now becoming a central theme of conversation at the board table. And if we can, and I suspect that is a massive move forward over 10 years, because
Stunning.
yeah. So, and it's happening all the way through the spectrum. And I do see that this is advancing at a speed we've probably not seen anything else in business, frankly, over certainly my lifetime. So I think the opportunity which that presents in terms of execution, as well as in terms of ultimately the benefits that come out of it on the ground or valuation is really exciting.
Yeah, well, I think that one area we haven't touched on is corporate governance, and I think that's the kind of big elephant in the room here. And specifically, that's what, in my mind, sets apart with this purposes kind of philanthropy versus purposes strategy. And if you have a public commitment by the board of directors, and this statement of purpose is issued not by the IR, but undersigned by the board, this is how you this is the first step towards embedding sustainability. But, today's directors, they're still worried about their fiduciary duties to investors, but they have to just remember that their duty is to work towards the long-term sustainable success of the company, and that long-term sustainable success of the company is directly linked to sustainability. So I think the mindset here is changing, but what is required for purpose to be practiced and for the words and commitments to be turned into action and impact is firstly, I think that it's a well-informed board, because the board needs to be informed on the outcomes of stakeholder engagement on a regular basis, and that should serve as a basis. First of all, there should be climate and social sustainability related expertise present at the board level, because otherwise there won't be enough of this constructive challenge of the executive team. And then the board agenda needs to be constructed at the outset, where every item is inclusive of stakeholder issues. It shouldn't be just a separate CSR discussion. It should be embedded in the work of individual board committees, and it should be a robust discussion, with sustainability as part of every decision. And then, of course, it needs to be linked to remuneration. That's an important element, because incentivization is going to be a key driver. And then, of course, non-financial reporting should report on the progress of this kind of, I would say, circular process, because these strategic decisions at the board level are then turned into deliverables for management and so on. And then, it's not some sort of a milestone where you say, here is success. No, the success here is kind of developing and evolving, and everybody should approach it as so.
Yeah, I think that's a really good point. Before we go to the audience, because we have a few questions being stored up, is there anything else anyone wants to add on corporate governance in particular?
No, I think that was brilliantly covered.
Maybe just one more point to add is that, even in kind of the jurisdictions like the UK, where corporate governance practices are regarded as some of the most advanced in the world, stakeholder engagement is not something that was typical for all boards. It was practiced by some of this kind of prominent organizations like Co-op and John Lewis and so on. But when it comes to emerging markets, I think that this is kind of unheard of. So I think that this is the biggest next kind of area to embrace, and to learn how for the board to promote stakeholder engagement at the board level.
I would just add to Katya's comment, actually. So one of the things that we, working with BlackRock and these others, when we put all this together, it's not a surprise that we got into this. It was designed specifically to address some of these issues. So one of the things we did make sure it was evidence-based. There was also board of director approval on that submission to bring it up to that corporate level was a critical point. And then the report that goes back to the company is in plain language.
Yes.
It highlights the positives and negatives. In Evie Hambro's words, it's the balance sheet of approach of ESG. So that there's the positives. No company is AAA. It would be impossible almost to get to that. but you need to have that journey to be able to try and achieve AAA in the right context with which you're in. And so it does provide that, which goes back to the company, back to the management, to allow that to be incorporated within the heart of strategy across the board, to be included as part of remuneration, and to have objective scores with that, and then make it a transparent and open opportunity for other stakeholders to be able to see it.
Very brief addition to this. We speak about governance, the classical information what ESG investment studies are telling, and textbooks, that transparency of the board is the key of governance if we speak about ESG point of view. And from my point of view, that it will be the next step after first we solved social licenses. Now we are working hard with decarbonization and all technical aspects, and then this will get into normality. Also, more digging will come into field. So we cannot avoid it. It will be part. It's already there are multiple recommendations how to implement this subject into risk management and portfolio assessment in the future, because a transparent board is related to company improvement of company performance. So in investment organizations, analysts, they do assess this for future returns, and it will be just, I think, strong with time. We will see it soon.
Thanks, Julia. We've got about 5 minutes or so of questions. You can see if they're storing up, so try and run through those as well. That would be great. Start.
I put it to the panel. Somebody can answer this. So, Dimitri, you say there's a Russian taxonomy. Now, I don't know how it relates to the taxonomy, but we know that the UK is going to have a taxonomy. And I can see the taxonomy. We worked with a steel company, and you can. We've got steel in the taxonomy, we've got aluminium in the taxonomy, but mining isn't in the taxonomy. And I find it quite hard. If you explain to a mining client, you say, this taxonomy is really important, it's got criteria, it frames the way you think about things. But mining isn't in there, it just shut down. Actually, well, mining isn't in there, it doesn't apply to us. So what would you say to a mining company? How does the taxonomy apply to you? How must you think about it? Yeah.
Sure. Thank you for the question, Jane. All right. So the Russian taxonomy, when we were creating the taxonomy, we obviously have drawn a lot of inspiration from the European taxonomy. But then we looked at the Russian economy, at the composition of the Russian economy. Oil and gas are very important sectors. Metals and mining is obviously very important. Mining is very important. And so we decided that in order to support the ecological transition of our economy, we cannot just have the purely green part, which does not include mining. We need to have a separate part, which we call transition taxonomy or adaptation taxonomy. It includes projects in traditionally, let's say, dirty fields like oil and gas and mining as well. For example, such projects as utilizing electric vehicles on mining projects, or implementing many types of projects which have positive ecological effects in these types of projects would be considered an adaptation projects. And this is also a part of the taxonomy. It is not called green. It has a special name for it. And so this was our solution.
If I could just jump in quickly on that. I mean, the EU taxonomy comes from the kind of historical development of EU legislation, which has traditionally been light on natural resources. And, there's a reason for that. And that's because member states do not want Brussels telling them what to do with their natural resources. They've historically said, keep your nose out of this. That said, as was indicated, there's a lot of stuff around a mining operation. Transport, for example, power supply, some of the processing, where the taxonomy can apply. Now, the way that we look at it, there is this applicable taxonomy, but then there's also best practice, whatever that means. And we're not short of best practice in the mining sector. There's a lot of standards out there, World Gold Council, et cetera, et cetera. So if you like, when we're looking around a definition of sustainability on a project, I hate to use this word, but sometimes there can be a kind of bespoke approach where you're using the taxonomy where it is applicable, but then also looking at key risks and putting mitigants in place that you know are going to deliver the right results. So, you know, some of it is a little bit of mix and match, and the legislation and the industry will move this forward together. But it is possible to put a structure in place where you can define the sustainability and put in place monitoring and verification on top of that. Possible.
Okay. Any further questions?
Just before we're answering the next person who puts their hand up is Jane. I challenged the Critical Minerals Association, that lobbying group, as to why mining, there wasn't a chapter of mining at COP26. And the argument that came back simply was mining is too associated with coal mining, and therefore they couldn't get their head around it, and therefore it didn't. So I don't know. So there seems to be an education issue which we need to address in mining, and I was staggered by the answer.
Disappointed.
You just can't separate out mining, you know, of all the other good products from just coal.
There's an opportunity to ask a question. I'll be heading the next panel, and it will have to do a lot with data. And I'm curious, what is your experience, whoever wants to pick up this, the data that they received, you know, already have experience with a lot of data that has been submitted to you. Is the volume, quality, transparency, is that an issue? Or like, the actual numbers that you receive?
Look, no, we kind of design the monitoring system so that we know what we're going to get in terms of quality and in terms of volume. You know, I would be lying if I said that we were a fantastically tech-savvy institution. It's not true. It's getting a lot better, and digitalization is going to be one of the key aspects that's going to impact us going forward. We need to catch up on that so that we're able to better gather and interrogate the data. But, you know, from terms of a sustainability framework, you put the effort in at the front end, and you know what you need, and you work with the client to make sure that you're going to get delivery in terms of volume and in terms of quality that will enable you to assess the performance of that project. But, you know, the way that technology is developing now, the opportunities there, we can really make a change over the next couple of years with that, and start to make it more of a management tool, a real-time management tool, rather than a kind of retrospective monitoring tool, which it has been in the past.
Okay, now I'm sure we've got a couple of the questions stored up, but we are running over. We've got coffee break outside, so if you'd like to speak to any of the speakers, come down to them now, or just grab them in the coffee area if you've got any further questions. But